Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It's December 12th of 2022, and I'm certainly glad that everyone could join us today. And thankfully, there's less than a month left of the year. And I think that I can speak for everyone that we want to say good riddance to 2022. It's been a bad year from a market perspective, whether you've been invested in stocks or bonds. Things are down around 20%, right? Now, our growth strategy, the opportunity strategy is down more than that, and we're cognizant of that. We've significantly underperformed the market this year, and we need to do better. And we're going to go through the game plan as to how we plan to do better in 2023. But let's go ahead and get started. And, the title of this week's presentation is The Plan for 2023. Right? We want to rebuild that performance after a bad year this year. And we have to own that, right? We have to say, what did we get wrong? What was wrong in our process? How do we improve the process? And where can we identify those areas of emerging leadership, right? One of the things we know, and we actually identified this in 2021, but we didn't have the conviction to stay with it, was that technology was showing signs of deterioration and was likely passing the baton of market leadership for probably a significant period of time, the next 3, 4, 5, 6 years and beyond. And so what we definitely don't want to do is go back to the things that worked 3, 4 years ago in terms of stocks, because those stocks are going to take time to repair. And so right now we are focused on 3 things. Staying focused on areas of emerging leadership. Number 2, let's not chase bottoms in yesterday's leaders, right? So I know everyone wants to know when the bottom is going to be in Amazon and when is the bottom going to be in Apple. It could be a while, right? Apple still trades at 28 times earnings, trades at a 2 trillion market cap. I mean, if we went to 900 billion market cap, that would only take you back to 2019. So there's a lot of things here. There's a lot of money that is structurally invested in the top of the market, that 30 to 40% weight of the S&P 500. And I think we want to be patient there. I don't think we want to chase the top of the market. And then lastly, really focusing on hitting singles and doubles and compounding those returns over time. So for the economic themes in 2023, economic growth does appear to be slowing. Right? That's not changing. I think the last 3 months, everyone knows we're pretty bearish on the rate of change of economic growth and likely going to some level of contraction. But we do think inflation is also coming down with it. And although we'll still remain above that 2% Federal Reserve target. So what does that mean? A lot of things going on here. What does that mean? Stagflation. Right? We were going into 2023. We kind of assumed that we're going to be, from the economy perspective, in this malaise, in this stagflationary environment that just doesn't make anyone happy. Fortunately, there is a way to make money in that type of environment. We have the playbook for that, and we believe that's the 1970s. A few things. We think we're going through what's called a rolling recession, right? So technology has been at the center of the storm. There's a recession in the technology sector. You're seeing that is where the layoffs are taking place right now. Right now, we do have a 0% weight in technology. Number 2, we saw that rolling into the housing sector when mortgage rates went up. Now, there are signs that that part is actually beginning to lighten up. So the bottom line is we don't think that we're getting this full throttle massive impact recession like we got in 08. It's more like that 2000 to 2003 time period that's just rolling into different sectors one by one. There's also a leadership transition in the market like we talked about before. For the last 10 to 12 years, it has been very top heavy in technology, communications, healthcare, and consumer discretionary. Technology and communications in particular, 40% of the market. We think that over time, technology is giving away that leadership, and you're going to see a market share shift out of technology, out of communications, and into some of the more unloved sectors that have been discarded for a while. And we think the third theme here is rock over paper. And what do I mean by rock over paper? For the better part of 12 years, paper assets have been key. But we think as interest rates normalize, as inflation remains stubbornly above that 2% target, and that the US dollar starts to come down in value, that assets like gold and copper and met coal are going to continue to increase in value. And gold has done nothing for about 12 years as an asset, but gold stocks have done even worse. And we think that's one of the deepest value sectors in the market right now. So how do we make money in this market, right? How do we make money in a stagflationary environment? First, we want to identify areas of improving relative strength. So as the market's going down or up, what are those stocks that are performing better than the S&P 500? They're exhibiting leadership, exhibiting leadership. Number two, assets that bottomed ahead of the overall market. So in 2008, we got a real big clue that technology was going to be the leader, because the Apples, the Googles, the Netflixes of the world, they started to bottom in October of 2008, even though the market didn't bottom until March of 2009. This time around, we're starting to see things like the golds and the coppers and the met coal names and the energy names bottoming well ahead of whatever this market bottom turns out to be, right? So we look at the solar names near 52-week highs. We look at the energy names near 52-week highs. We look at areas such as copper, right? Those copper names are breaking out. They'll actually look quite attractive here in terms of when you look at the charts and the fundamentals and everything else. So the home builders are breaking out, right? And we're going to go through all of that here in a bit. And then, of course, we want to avoid areas of leverage and falling relative strength. That's just a fancy way of saying, let's not try to chase the bottom of the market, yesterday's leadership. Now, we put this market matrix together. We kind of wanted to put things in a little bit of an image for everyone. So right now, what we see is we kind of want to target this top right quadrant, or names that are on their way over to this top right quadrant. So that's a combination of good price action and improving relative strength. What are sort of the areas that we see there right now? Home builders, consumer staples, energy, and base metal stocks. So base metal being copper, coal, those types of names, even the steel operators. The other area that's quickly racing toward here are gold names. And gold has been unloved for a really long time. Banks are quickly deteriorating. We have a 0% weight in the banks. They were showing deteriorating relative strength, and now the price action is getting bad. So they're moving over to the bottom left quadrant of this market matrix. Meanwhile, the cloud stocks, semiconductors, the ARK fund, sort of the profitless tech basket, the center of the storm, these remain well anchored in a downtrend. This includes your Amazons and your Teslas of the world, your Googles of the world, strongly in a downtrend with deteriorating relative strength and deteriorating price action. The one sector that's sort of bifurcated is the equal weight consumer discretionary sector. Why? Because a lot of consumer names are starting to act better, right? We look at the home builders, or if we look at certain consumer names such as Chipotle, right? Just throwing an example out there. Those names are actually acting better. But then you have the top of the consumer discretionary market, which is dominated by Tesla and Amazon, and they are quickly deteriorating, and they really fit into this bottom left quadrant, while some of the consumer names fit into this top right quadrant. So it's a stock pickers sector market in the consumer space. What are the current conditions of the market right now? Weakness by far and away is concentrated in tech. We have seen a pullback in energy names. So Friday and Thursday in particular of last week, we saw those names start to pull back. We think they're just pulling back into their breakout points. So we haven't seen their scoring deteriorate much more beyond they were overbought, and they're becoming a little bit less overbought. But most of the concentrated important weakness right now continues to be concentrated in technology, certain areas of biotech, and of course, all the profitless SPAC areas and IPO sectors, and all those things continue to dominate the downtrends. Number two, can a recession cause a housing bottom, right? And I pose that question because what's interesting is, despite all the rhetoric around the Federal Reserve, despite the rhetoric around interest rates, what we've actually seen is rates start to come in, and home builders are actually acting okay. I mean, if you talk to anyone, it's a uniform call that housing prices go down next year. Maybe they don't, right? Or maybe housing activity picks up. The charts are trying to tell us something that the headlines aren't right now. We're going to go through that. And then lastly, energy, base metals, and gold all continue to act well in this current tape. Technology we see here, we look at the top left chart, NASDAQ relative to the S&P 500 tried to rally. That was the rally that we missed in November. We don't own technology and has rolled over. When we look at technology communications, remains close to 40% of the overall S&P 500. I mean, we can see when we look at this chart going all the way back to 2014, yes, we've had a sharp correction in technology and it could be tempting to chase a bottom, but we're only back to 2020 levels. That's really important. We're only back to 2020 levels. There's names like Facebook, for example, that are already back to 2017 levels. And so we look at the multiples, the top of the market, especially in technology, there is more compression, we believe, to take place. And so we want to be careful here. Echoes of 2000, right? This is what we were talking about. So the combined weight of the 6 largest issues in 1999, Microsoft, Cisco, Walmart, Intel, Nokia, and IBM, that was around 15%. And what happened over the last 10 or the next 10 years was they just continued to leak market share away to all the other sectors in the S&P 500. Today is very similar, a huge run up with the only difference of instead of 15%, they're about 25% in terms of the 6 largest stocks. So that'd be Apple, Microsoft, Amazon, Tesla, Meta, and Google. So we need to be careful is the bottom line here. We don't see any reason why this market share won't continue to leak lower, at least back to 15% and maybe beyond that. In terms of gold, huge base, right? So does this mean gold's going to go up on Monday or Tuesday or Wednesday? I don't know, right? But what we do think is that gold is coming out of this decade-long bear market where gold stocks, gold assets have been underowned, underappreciated. I've been one of the biggest bears of gold over the last 10 years, but you got to adjust, you got to change. And this is one area we think is going to, we believe, will add a lot of value to investor portfolios, especially when we look at the banks. This is the top left chart here. The banks relative to gold are rolling over, and the S&P 500 relative to gold also appears to be rolling over. So when we think of that lost decade from 2000 to 2011, if you owned an index fund that was market cap weighted to the S&P 500, you actually lost money over 10 years. If you had an active strategy that could pivot away from that, even if you had the first year the pivot wasn't so hot like it is with us this year, but you could pivot into the new areas of emerging leadership, then absolutely you could have made money by being in gold and copper and met coal and certain areas of the consumer discretionary space. Same goes here. Copper, another giant base and breakout, right? So if we look at Freeport relative to Amazon, this is a huge bottom and breakout. We are, just for disclosure purposes, we are long Freeport. Wasn't the reason we use this chart. It's Freeport is your standard base metals weight that a lot of managers use to gain exposure. So again, Freeport relative to Amazon breaking out. Copper as a whole breaking out of a 10, 12-year base. And then we look at the US dollar. The US dollar going back to 1988 has given us really good clues as to where gold is going, right? If you can get the dollar right, you'll probably get gold right. And what do I mean by that? Gold is a currency. It's not a commodity in our opinion, it's a currency. When you're buying gold, you're making a call that the US dollar is going down. It's a bet against the US dollar. In the 90s, US dollar was strong, gold was in a bear market. From 2000 to 2010, US dollar was in a bear market and gold was in a bull market. We were in a bear market the last decade, US dollar was strong. We now think that this is a significant rollover period for the US dollar, and that is the main precipitating factor to get gold to go on its bull run. And then, of course, those mortgage rates we talked about, right? We were in the market for a house. Our family is, we're expecting our second child in March, and mortgage rates were over 7. It was painful. But now they've come down to 6.5%, right? So, quietly, you're not reading about this in the media, but they've quietly come back down. And you are seeing that here in the way the home builders are behaving, right? So what's interesting is the home builders, the chart here on the top left, is actually breaking out while mortgage rates are coming back down. So what's the bottom line, ladies and gentlemen? It's still time to be cautious. It's not time to go and buy a bunch of profitless tech, but we do think the market is giving us some clues about the future leadership for 2023. Those areas of leadership tend to bottom ahead of the overall market. Base metal producers, gold names, energy, even though it's going through a little bit of a pullback right now. We think those are core areas of leadership in the market that will exhibit continuity as we get into the new calendar year. We don't want to chase that form of leadership such as technology, and lower growth and stubborn inflation we do think will remain key themes for 2023. Thank you again to everyone. We will be doing either an audio only or an email blast next week, as I will be out of town, but we will be back at it the week after. So thank you again. If you have any questions, please feel free to reach out to myself or anyone here at our office or your advisor. We know that it's been a really tough year, and we want to do everything we can to make you feel comfortable, whether that's a change of strategy or to really walk you through the changes we're making in this particular one. So thank you again, and have an absolutely fantastic week. Thank you.